All right, let's get real. The crypto market is down bad. Everything you see, everything you hear is telling you to do one of two things. Sell everything for a loss to protect what's left, or just hold on for dear life and pray for the next bull run. Your portfolio is a sea of red, probably down 60% or more, and every new dip feels like a punch to the gut. The common wisdom says your only choices are to give up or to go into hibernation. But what if I told you there's a third option? An option the smartest investors, the ones who come out of these markets with way bigger portfolios, are using right now. An option that lets you actually grow your crypto stack even when prices are tanking. This isn't about perfectly timing the bottom or messing with risky leverage. This is about transforming your portfolio from a passive bleeding account into an active asset that works for you 24/7, making money no matter which way the market goes. In this video, I'm pulling back the curtain to show you the exact strategies I use to generate passive income in a bear market. We're going to start with the safest, most foundational methods and work our way up to the advanced stuff the full-time DeFi pros use. By the end of this, you'll have a complete playbook to not just survive this crypto winter, but to actually thrive in it, setting yourself up for huge success when the market finally turns. Before we jump into any strategies, we need to talk about the most important part: your mindset. Right now, the market is gripped by extreme fear. The fear and greed index is at rock bottom, hitting levels we haven't seen since the darkest days of past cycles. Bitcoin and Ethereum have been falling for weeks, wiping out gains and shaking the confidence of even the most dedicated believers. It feels awful. That pain is real, and the first step is just to acknowledge it. The typical reaction: paralysis. You see your net worth drop and you just freeze. The problem with the just HODL approach is that it treats your assets like dead weight. You're a passenger on a ship in a storm and you've let go of the wheel, just hoping you don't sink. The mindset shift we need is to go from being a passive holder to a proactive earner. Think of your crypto portfolio like a collection of digital real estate. When the housing market slumps, a smart landlord doesn't just stare at falling property values. They make sure their properties are rented out and generating cash flow. That cash flow pays the bills and can even be used to scoop up more properties at a discount. This is exactly what we're going to do with our crypto. Why does this matter so much? Because every single token you earn from passive income lowers your average cost. If you have one Ethereum and you earn 0.04 ETH over a year from staking, you now have 1.04 ETH. Even if the price of ETH goes nowhere, your stack has grown by 4%. When the bull market comes back, you don't just get the price jump on your original ETH, you get it on all the extra ETH you piled up during the downturn. This is the fundamental difference between people who just survive bear markets and those who come out of them way wealthier. They get that bear markets aren't a time to hide, they're a time to build. This is when assets move from scared retail investors to patient long-term players who have a plan. Our plan is to use passive income to become those patient accumulators day in and day out. Okay, before you can start generating income, you have to protect what you have. Trying to run advanced strategies with a portfolio full of speculative, sketchy altcoins is like trying to build a skyscraper on sand. It's a recipe for disaster. In a bear market, there's a flight to quality, and we need to respect that. So the very first thing we have to do is structure our portfolio defensively. This is where the core satellite approach comes in. Your core should be the blue chip assets of crypto, Bitcoin and Ethereum. For most people, these should make up 50% to 80% of your total crypto portfolio. Why? Because these are the assets with the most liquidity, the strongest communities, and the most trust from big institutions. They're the most likely to survive the winter and lead the recovery. The satellite part of your portfolio is where you can take a few swings on emerging stuff. Maybe some layer 2s, new DeFi protocols, or gaming projects. But you have to be disciplined. Each of these positions should be small, maybe 1% to 5% of your total portfolio. This setup ensures that if one of your wilder bets goes to zero, which can definitely happen in a bear market, it doesn't sink your whole ship. The second and maybe most important part of your foundation is what we call dry powder. This is a chunk of your portfolio you keep in cash, or for our purposes, high-quality stable coins like USDC or USTT. It should be a meaningful amount, say 10 to 20% of what you plan to invest in crypto. This is not lazy money. This is your opportunity fund. It does two crucial things. First, it's a psychological cushion, giving you stability and stopping you from panic selling when things get ugly. Second, it's the cash you'll use to jump on amazing opportunities, both for buying more Bitcoin and Ethereum when there's blood in the streets, and for fueling the income strategies we're about to cover. Finally, a word on security. And please do not skip this step. Any assets you're holding for the long haul need to be moved off of centralized exchanges and into a self-custody wallet, like a hardware wallet. In a bear market, the risk of an exchange collapsing goes way up. We've seen it happen over and over. Protecting your assets is everything. You can't earn yield on coins you don't own anymore. And keep your living expenses totally separate from this. Rent money is never, ever crypto money. With a solid portfolio and ironclad security, we now have a stable base to start our income-generating operations. Our first strategy is the simplest, safest, and most essential way to earn passive income: staking. Specifically, we're going to focus on staking Ethereum, which is the cornerstone of the whole DeFi world. So what is staking really? In simple terms, you're helping to secure the blockchain network. By locking up your ETH, you help validate transactions, and in return for that service, the network pays you with more ETH. It's a straightforward, transparent, and pretty low-risk way to make your assets work for you. You're earning yield that comes directly from the protocol itself, not from some risky, complicated scheme. Now, it used to be that you had to be a tech wizard and have a ton of ETH to run your own validator node, which was a huge barrier for most people. But the game completely changed with liquid staking. This innovation is, hands down, one of the most powerful tools for a passive income investor, and it's a massive focus for DeFi in 2025. Liquid staking protocols like Lido Finance, Rocket Pool, and Frax Finance have totally changed the game. Here's how it works. You deposit your ETH into a protocol like Lido. In return, you get a derivative token, in this case, STETH, staked ETH, on a one-to-one basis. This STETH token automatically collects all the staking rewards. So if you hold one STETH, after a year it might be worth 1.04 ETH. The magic here is that while your original ETH is staked and earning yield, the STETH token you're holding is liquid. It's a standard token you can use all over DeFi. You can trade it, lend it, or use it as collateral. This is what we call capital efficiency. Your money is working for you in two places at once. Liquid staking has become a cornerstone of DeFi, with total value locked, TVL hitting record levels of around $86.4 billion in mid-2025. Platforms like Lido hold a huge chunk of that market, which shows how much trust people have in them. Rocket Pool offers a more decentralized option, letting people stake smaller amounts of ETH or run a mini pool. These platforms typically offer an annual percentage rate, APR, that hovers around 3 to 5%, though it can change depending on network activity. While that might not sound as crazy as the quadruple-digit APYs you see advertised in sketchy corners of crypto, this is a real, sustainable yield on a blue-chip asset. This is the bedrock of a bear market income strategy. The risks aren't zero, but they are much lower than other DeFi activities. The main risks are smart contract risk, the chance of a bug in the code, and the small risk that the price of STETH could temporarily trade for less than ETH. But the major protocols have been running for years, have been audited many times, and have proven to be incredibly tough. For anyone starting their passive income journey, liquid staking ETH is the most logical and safe first step. Once you've got your core ETH staked and earning a base yield, the next move is to put your dry powder to work. This is where stablecoins come in. Earning yield on stablecoins is one of the best bear market strategies because you generate income without worrying about the crazy price swings of Bitcoin or Ethereum. You're protecting your capital while making it productive, so you're ready to pounce when the time is right. In 2025, the ways to earn with stablecoins have gotten much better, moving from simple centralized platforms to more solid decentralized options that generate real yield. There are really two main ways to do this. First, there's decentralized lending and borrowing. Platforms like Aave and Compound are basically decentralized money markets. You can deposit your stablecoins, like USDC, into the Aave lending pool. Other people can then borrow from that pool and pay interest. As a depositor, you get a cut of that interest paid out constantly. The APR you earn changes based on how much demand there is for borrowing stablecoins. When demand is high, your yield goes up. The best part is its simplicity and flexibility. You can usually deposit and withdraw whenever you want. The main risk, as always in DeFi, is smart contract risk, which is why it's so important to stick with battle-tested, audited platforms like Aave. The second, and often higher yielding approach, is providing liquidity for stablecoin pairs on a decentralized exchange, DEX. This is where you can really see real yield in action. A DEX like Curve Finance specializes in super efficient stablecoin swaps. Millions of dollars in volume flow through these platforms every day as traders swap between USDC, USTT, DAI, and others. To make those trades happen, the DEX needs liquidity, and you can be a liquidity provider, LP, by depositing your stablecoins into one of their pools. When you do this, you're basically a market maker. Every time a trader uses your pool, they pay a small fee, and a piece of that fee goes directly to you. This is real yield because it's coming from real economic activity, trading fees, not from printing inflationary tokens that just lose their value. In a bear market, trading volume between stablecoins can actually stay high as people de-risk, making this a surprisingly solid source of income. With the rise of concentrated liquidity on platforms like Uniswap 5.3, you can take this even further. You can provide your liquidity in a very tight price range, for example, between 99 cents and $1 for a USDC DAI pair. By focusing your capital where all the action is, you can earn way more in fees with the same amount of money. The main risks here are smart contract risk and the tiny risk of a stablecoin losing its peg to the dollar. But by sticking to the most reputable stablecoins and platforms like Curve and Uniswap, you can build a reliable income stream of 4 to 7% or even higher on your cash reserves. This strategy turns your lazy dry powder into a yield-generating machine, growing your cash stack while you wait for the perfect time to buy. Hey, if you're getting a lot of value out of this deep dive into DeFi and bear market strategies, do me a huge favor and hit that subscribe button and turn on notifications. I put out detailed guides just like this every single week, and my goal is to give you the tools you need to become a smarter, more profitable investor. Your support really helps the channel grow and lets me create even better content for you. All right, now let's get into the more advanced stuff. Now that we've covered the foundational layers of staking and stablecoin farming, we can move up the risk and complexity ladder. This is where we get into advanced yield farming and providing liquidity for volatile assets. And let me be clear, these strategies are not for beginners. They take more active management and a deeper knowledge of how DeFi really works, but they also offer the potential for much higher returns. The most common type of advanced yield farming is acting as a liquidity provider, LP, for a volatile pair like ETH/WBTC or ETH/USDC on a DEX like UNISWAP. The idea is the same as with stablecoins. You deposit an equal value of both assets into a liquidity pool and earn a cut of the trading fees. Since these pairs often have higher trading volumes and fee tiers, the APYs can be much more tempting, often ranging from 10% to 30% or even more. However, this extra return comes with a very specific risk you absolutely have to understand. Impermanent loss, IL. This is a term that scares a lot of people, but it's not as complicated as it sounds. Think of it this way. Imagine you're a money changer holding $500 worth of US dollars and $500 worth of euros for a total of $1,000. If the euro suddenly doubles in value against the dollar, traders will rush to you to swap their dollars for your now undervalued euros. You'll end up with more dollars and fewer euros because you sold the asset that was going up in price. Your total portfolio value, if you pulled it out right then, would be less than if you had just held your original dollars and euros separately. That difference is impermanent loss. It's impermanent because if the prices go back to where they started, the loss vanishes. But in a crazy market, it can become very permanent. In a bear market where assets are mostly trending down, IL can be a real drag. However, the fees you earn can help balance out this loss. The name of the game is finding pools where the fee income is likely to be higher than the potential impermanent loss. Platforms with concentrated liquidity like Uniswap v3 make this even more interesting. They let you provide liquidity in a specific price range. If the price stays in your range, you earn amazing fees. But if the price moves outside your range, your position effectively turns into 100% of the asset that's dropping in value, and you stop earning fees altogether. It's a high-stakes game of active management. To make this whole process easier, a lot of people use yield aggregators or vaults. Platforms like Yearn Finance and Beefy Finance are essential tools for any serious yield farmer. Think of them as automated strategists for your crypto. You deposit your assets into a vault, and their smart contracts automatically run complex strategies to get you the best possible yield. They'll automatically claim your rewards, sell them, and put them back into the pool to compound your earnings. This saves you a ton of time and, just as importantly, gas fees. When you're dealing with advanced yield farming, risk management is everything. Start with small positions. Diversify across different platforms. And most importantly, never chase some ridiculous APY without understanding exactly where that yield is coming from. Usually it's paid in inflationary farm tokens that are designed to dump to zero. Stick to platforms that generate real yield from trading fees or lending. This next strategy is the most complex one we'll talk about today, and it's really for professional or highly experienced investors. It requires a solid grasp of derivatives, funding rates, and active management. This is the delta neutral strategy. So what does delta neutral even mean? In simple terms, it means you're setting up a position where its value isn't affected by small price changes in the underlying asset. If Bitcoin goes up or down by 1%, your net value stays the same. You've canceled out your directional risk. So if you're not making money from the price going up, how do you profit? You profit from the mechanics of the platforms themselves. The most common delta neutral strategy in crypto is called the cash and carry trade, which combines a spot position with a futures position. Here's how it works. Step 1, go long on spot. You buy an asset on the spot market. For example, you buy 1 ETH. You can even level this up by using that 1 ETH to earn more yield, for instance, by turning it into a liquid staked token like Steth to get that base staking yield of around 3 to 4%. Step 2, go short on a perpetual future. At the same time, on a derivatives exchange, you open a short position for the exact same amount. In this case, you short 1 ETH using a perpetual futures contract. This short position is your hedge. If the price of ETH drops by $100, your spot holding loses $100, but your short position gains $100, and they cancel each other out. Your position is now delta neutral. Step 3, earn the funding rate. So where's the profit? It comes from the funding rate. Perpetual futures need a way to stay pegged to the spot price, and this mechanism is the funding rate, a payment exchange between the longs and shorts. In a market with bullish sentiment, there are usually more people going long than short. To balance this, the longs have to pay the shorts a funding fee. As the person holding the short position, you would be collecting these payments. These rates are highly variable, but they can sometimes spike to levels that equate to APYs of 10%, 20%, or even higher for short periods. Your total profit is the yield from your spot position, like the 4% from staking, plus the funding rate you get from your short position. You're earning from 2 different sources while being protected from price swings. Now, this might sound like a free lunch, but it is absolutely not. The biggest risk is that the funding rate can flip negative. If sentiment turns bearish and more people are shorting, the shorts have to pay the longs. Your hedge would now be costing you money. Second, there's liquidation risk on your short. If the price of the asset suddenly skyrockets, your short position could get liquidated if you don't have enough collateral to back it up. Finally, it's just complicated to manage positions across 2 different platforms. This is a powerful strategy for generating income that isn't tied to market direction, but it is not passive. It requires constant monitoring and a deep understanding of market mechanics. I want to finish with one last strategy. It isn't a passive income strategy like the others, but it is arguably the single most important and effective bear market strategy of all. Dollar cost averaging, DCA. It's the accumulation engine that works perfectly with everything else we've discussed. DCA is simple. You invest a fixed amount of money into an asset at regular intervals no matter the price. For example, you decide to buy $100 of Bitcoin every Friday. When the price is high, your $100 buys less Bitcoin. When the price is low, that same $100 buys you a lot more Bitcoin. Over time, this smooths out your purchase price and, in a bear market, dramatically lowers your overall cost basis. The real magic of DCA, though, isn't the math. It's the psychology. Trying to time the exact bottom of the market is a fool's game. Even pros can't do it consistently. DCA takes that impossible task off your shoulders. It automates your investing, forcing you to buy when it feels the absolute scariest, which is almost always when the best opportunities are. It replaces fear and greed with pure discipline. Think about an investor during the brutal 2022 bear market. While everyone else was panicking and selling, imagine she just kept putting in her $2,000 every month. Then, when the market hit peak fear in November 2022, she didn't just stick to the plan, she upped her contributions to $3,000. Those extra buys made when there was blood on the streets would have generated massive returns during the recovery that followed. That's the power of systematically buying during periods of despair. So how does this tie into our passive income strategies? It creates a beautiful self-sustaining loop of wealth creation. The yield you're making from staking, stablecoin farming, and your other strategies shouldn't just sit there. You can use that passive income to fuel your DCA strategy. Imagine you're earning $200 a month in yield. You can set up an automated process to use that $200 to buy more Bitcoin or Ethereum every single month. You're using the income from your assets to buy more income-generating assets, all at cheap bear market prices. This is the ultimate compounding machine. It transforms you from someone just trying to survive the bear market into someone who is actively using it as a weapon to build long-term wealth. So let's wrap this up. The crypto market might look like a disaster zone right now, but you are not helpless. You don't have to choose between selling at a loss or just sitting on your hands and hoping. By shifting your mindset from passive to proactive, you can turn this downturn into the most productive part of your investment journey. We've walked through a complete playbook, starting with the non-negotiable foundation, a defensive portfolio of blue-chip assets, and a secure self-custody setup. From there, we built our income stack layer by layer. We started with the bedrock of liquid staking to earn a reliable yield on our core holdings. Then we moved to the safe harbor of stablecoin farming, turning our cash into a productive asset. For those who are a bit more adventurous, we looked at advanced yield farming and even touched on the pro-level delta neutral strategies that make money no matter what the market is doing. And finally, we tied it all together with the simple discipline of dollar cost averaging, using the income from all these strategies to build our stacks bigger and bigger, creating a powerful flywheel of compounding wealth. The bear market is a test. While everyone else is frozen by fear, you now have a set of tools to take control, to make your portfolio work for you, and to build a much stronger foundation for the next bull run. This is how you stop the bleeding. This is how you win. If this video gave you a new way to think about bear markets, please hit that subscribe button. And for your next step, check out the video on my screen where I break down exactly how I structure my portfolio for a bull market. Thanks for watching, and I'll see you in the next one.